Welcome to Just Think About It with Nadine and Ben. We're recording this episode on Tuesday, October 8th. And before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via our website. Apple, Spotify, X, YouTube, or your platform of choice can be found. Make sure to hit the like button. And second, we appreciate any kind notes as we get started and letting your friends know where to find us. Today, we're so excited to delve into the emerging markets global economy with Hugh Hendry. Hugh is a longtime Wall Street veteran who earned his spurs working for Crispin Odey in London and then went on to found and manage Eclectica Capital Management, a global macro hedge fund for over 2 decades. He was famous for putting up 50% returns in 2008 and now spends his time researching and producing content for his research and podcast outfit, The Asset Capitalist. Welcome, Hugh. Thank you so much for coming today.
I mean, I am stoked. I'm terrified. You guys are like the smartest podcast on the street. I'm a fraud. It's going to become very evident.
No, we have so much to get out of you today. So before we get too far into the conversation, though, I'm hoping we can spend a little bit of time telling our listeners who might not be familiar with you about your background. So you're known as the asset capitalist and bring a very distinct approach, one that I tend to love here. From the style to the investment approach to managing money, idea formation markets, as well as your overall aura here, Hugh. Could you tell people, what is the overview of your investment philosophy and let folks know what are you best known for?
Wonderful. Okay. I'm best known for irony and paradox.
Okay.
I entered the hedge fund fray in the year 1999, April 1999, with the eponymous Crispin Odey. And for anyone who's actually cognizant of such things, it has to be said straight off the bat, Crispin, for all of his intellectual genius, is a disgraced figure now in the world of finance. Many allegations thrown at him with regard to, if you will, Me Too.
Sure.
And so that has to be acknowledged.
That's separate, though. So we're not keeping you with that baggage, but I appreciate you bringing that up because it's important that, everybody's legacy is tied to something. So I appreciate you bringing that up.
Full transparency, but I have to say to you that he was critical in my fusion and formation into the asset capitalist, because up until that point, I had spent 8 years with a magnificent long-only investment management group in Edinburgh, in Scotland. And this is the accent you hear. Baillie Gifford. And that was a shop that sought to control risk through the discovery and investment of superior businesses. That such businesses were going to be less prone, less volatile, and therefore easier to hold and then extract the risk premium. I was an abject failure.
At what?
Within the realm of controlling risk through narrative. It felt to me akin to being in a cave, not with Plato, or maybe I'm sure he was in some distant recess, but I want to say with, I don't know, the Mujahideen, the guys with the beards, the Taliban, because it was the daily recital of the tenets of the
mantra
law.
of what.
So it is a very unique investment organization, because they would take young investment graduates. I mean, I started at the age of 21, and within 2 years, I was managing live risk. But you were given revolving geographical equity tours. My first year, I was assigned to the Japanese equity team.
Okay.
And remember, this is
right after the bubble, right?
Say again.
Would it have been right after the bubble? Like right after?
Yeah, this is 10 months or 9 months after the Great Peak. This is September 1990. And this was the department with politics, everyone wanted to join the Japanese team. That's where the money, the prestige was. Um, I was assigned that initial role because, and here I'm going to tell you my secrets. But so I, I'm going to say it. It pains me to say, but I had a Bachelor of Arts degree, joint honors degree in in accountancy and economics. There, I said it. I
Yeah,
said
I
it.
wouldn't have guessed that. So thank you for bringing that up.
Yeah. Hey, listen, like I came from a violent, I think you call it project, and I mean, none of the predecessors had ever been to a university, and so I'm like, what do you select? And so, like, my father's a truck driver, so I'm like, well, being an accountant, that sounds like a step up, you know, and um, and all of my story, I don't want to get stuck in that story, but.
Yeah, right. So you're back there, like you're on the Japanese team, and like, what is it that you took out of that situation?
The blindness, the ego and the desire for the good times to come back. But
Yeah.
so I was channeled and charged with the responsibility of reviewing the companies that we were invested in. We ran in concentrated investment portfolios. And again, the Taliban, there was a process. The annual report would arrive.
Yeah.
And I, like a junior analyst, I was designated to deconstruct and then to put it back into the house way, if you will, and then write a discursive essay, which would be arguing, buy more, hold, get rid of this damn thing. We would then coalesce around the department view. And then I would be charged. And again, this literally 4 or 5 weeks after joining, I was sitting in a grand boardroom in a Georgian mansion in the opulent squares of Edinburgh. And I was presenting to 2025 really seasoned, the smartest people you can imagine. And I tell you, like syntax, if I had to produce a paper and hand it out beforehand. And if there was a syntax error, my life was a misery. So I did that. And then once a month, I was charged with presenting an economic review of the developments within the terrain of Japan to the entire partnership and wider investment stuff. And again, scrutiny, if you did not know your thing, you were taken down. I recall this kind of in the news of late because the first stock that I reviewed was Ito Yokado, which owns 7-Eleven and a large group of, or it did. I think they've now separated. And back then, this was arguably the most shareholder, and that's not saying a lot, but shareholder centric and switched on Japanese organization, largely because they had a substantial US interest. And I concluded, I was like, hey, I'm new to this business. It's on 56 times earnings. I think that's bonkers. But in the world, Gulliver's Travels, in the world of crazy people, this seems just a little bit less crazy, And the senior part is like, I don't know. So that was my introduction, if you will. But it stopped there. And so let's fast forward to hedge fund and the meeting with Crispin Odey. And the revelation. So Crispin for me was like meeting Mozart. He was just the most extraordinary Lord, but he was all of that. And suddenly I was there. And I'm like, well, how do you compete? I'm sitting at the piano, my computer. I'm like, and I'm looking next door. I'm like, how do I compete? So I mean, it was kind of tough. But in terms of grounding and formation, he taught me let's concentrate on 3 words: curiosity, playfulness, and mischief. Okay. We have a malleable mind, and when he had conducted his due diligence and he had spoken to my former employers, they had reported, he's a troublemaker.
They're like check playfulness, yeah, okay.
And Crispin, to his incredible credit, recognized what is depicted in all the great military misadventures. All these, I'm sure. I mean, Ben is like, I'm sure both of you are prodigious readers. I mean, I struggled to get through Condé Nast Traveler, but but the undoing of the great military leader is at the end. After all the glory, they're surrounded by sycophants, and they accentuate the error, and that's the end. And so Crispin recognized that danger, and I didn't know anything about vintage wine and the art market, but oh my God, if you wanted an argument in finance, I was your guy. Yeah. And then finally, just to close that one off, he 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 used charts. He used charts. And remember, I was like, I was from a cave in Edinburgh. I'm
We're
like,
doing the fundamental build
so,
up of the
like,
financials. You're doing your accounting. That's right.
Yeah, Bailey Gifford reminds me a bit like my first firm. We actually have a similar background. I started Fidelity, and it was like, what are their earnings going to be in 2 years? Tell me the story of what their earnings will be in 2 years. And then I got around to where you did, and it's just kind of a funny thing how that goes, where you actually want to be much more contrarian. And in places like that, they're not really big on contrarians, are they?
well,
No.
I'm telling you, may I tell you two funny observations? So, as a desk analyst, my day would begin with a paper dump. I mean, literally, I don't know if you can see it, but like, and then a leaning tower of pizza would arrive on my desk, and I was charged with sifting through it, finding the research relevant to our holdings, perhaps relevant to the curiosity of the PMs, and then dispatching the others. And would you believe it? Even I had to file it. We had a library. We had a folder on every company. Okay.
We did too. Back then though, fundamental work could give you an edge because it wasn't online, right? Like it was different, and you had man hours. It was much more private equity approach to the public markets. It was just a different time back then.
I'm not dishing. I'm not dishing the fundamentalists. It is an absolute ironclad essential skill set.
It's not enough.
It's not enough. Okay.
Right.
And I reached the point. I was so disheartened because I'd finally get through it, and of course, then another pile and another pile, and so I ended up. It was like a scene from a mafia movie, where you're trying to dispatch of the dead body. I was like, I've got to make all this paper disappear. And so I had a black refuge bag, a bin bag. And when no one was looking, I would slide.
Just dump it in.
And at lunchtime, I'm like, I'm just popping out.
I gotta go. But let me rein you in here for a second, okay? So we're getting the fundamental approach. Then your world opens up to someone who you maybe believe in more, feel more akin to a different style. But from that point till today, what would you say is your investment philosophy if you could nail it for people who may not be as familiar? What does it mean to follow Hugh Hendry?
Thank you, Nadine. So I sat there, and eventually I was given responsibility and launched my own hedge fund, the Eclectica Fund. This is October 2002. And I sat there and I thought, the best remunerated minds on the planet were managing speculative pools of funds that we call hedge funds.
Right.
And I'm very proud that I had the deduction to conclude that it would be absurd for a kid like me to seek to outsmart the smartest people on the planet.
Right.
That was my deduction.
Okay.
And so I approached the issue of performance and seeking tenure by trying to deconstruct that. And I said to myself, so why is it that being super smart, like just the minimum entry?
Right. You're like everybody else. So it's like, so what? What's next?
So I asked myself, what are the circumstances when genius fails? Because I'm going to be the guy when they throw their hands up and they say, heavens, who could possibly have conceived of this? And out of sight, I'm like, well, me, I'm eclectic. And that is my thing. So I channeled notions of irony and paradox. Another thing I used to say was this notion of people would, and I'm sure many people tuning in are like, who is this moron? Now,
No.
now, I am not a moron. I am.
I like that. Go ahead. Sorry.
You should do that as a short.
That's right. I am a moral.
You're breaking my
Sorry,
poor
sorry.
people. You're breaking my poor. Okay, again, let me continue. To reiterate, I am not a moron. I'm an oxymoron.
Okay.
Okay. And let me give you, let's play with that. I am a trend following contrarian. Deduct what you will of that.
So let me unpack that a little bit. Is that like I'm looking at charts, let's say gold right now. Gold's a nice trend following chart right now. And you're saying, hey, I'm thinking about why will this trend not work anymore? I'm not just going to be a quant monkey that like goes past some trend line. I'm going to be like, okay, where is it not? Or how could I be wrong in essence? Or why is the market wrong? But in general, making money, it's easier to make money being a trend follower than it is to constantly be a contrarian. Is that fair? Something along those lines?
But that is certainly fair. Okay,
But can I add one more thing that I'm going to guess? Can I guess? Yeah. So in my mind, though, it's really hard to make money if you're with everybody else, because then the odds, you make money when you're right and they're wrong, because not only do you get paid on your idea, but the money has to flow to you from them because they're wrong. So you kind of get paid twice, right? And so the risk, I think you get less risk when you're doing that, because if everybody's on the opposite side of the trade, there's not left juice in that lemon to squeeze.
I disagree.
Tell me why.
Because macro is the most exceptional asset class, and exceptional I want to say in a possibly a pejorative term, in that it has no beta. And actually, the rise of asset prices these last 40 years, you have been paid handsomely to be part of the accepted belief system, and the beta has been mistaken time and time again for an inexistent alpha. The only alpha that exists in the world, well, it's a bit absolute, but alpha only exists really in the world where there's no beta, and that's our world. That's the world of macro. It's fiendishly difficult. Okay. Now to the point of the trend following.
Yeah.
Again, let's do redux. I'm a simple guy, all right? And I needed simple rules. And my rule was, I'm going to buy things going up. And I'm going to sell, I'm going to lighten on things going down. And I know, what was I seeking? I was seeking longevity of a career. I love it. I love waking up every morning. It's amazing. I want more and more of it. And that came out of, again, an experience from Edinburgh. I had my career was collapsing, and who was our guru? It was the Sage of Omaha. And I thought to myself, I need a Hail Mary. I need a trick to resurrect myself. And I convinced myself that I had discovered the next stock that Warren Buffett was going to buy. And if I was right, they were making me a partner. Okay. And I bought Reader's Digest, and I bought more. And the share price went down. And what do? I'm a fundamentalist. I take my scriptures out. I read my scriptures. I buy more. I mean, thankfully, I amassed, it was our biggest position in our US equity fund. Thankfully, I got tapped on the shoulder and they closed me out. Yeah, and I was done. There was no coming back after that. And my takeaway from that was I was driven by the conceit and the arrogance of a well-formed argument. My argument was exemplary.
Yeah.
And I was
and I don't think
blinded
maybe
to
I
that.
said it right, because like you and I are actually very similar. That's where my trading signals come from, is you need to be going where where the trajectory is. But at the same time, if you stay too long, everyone's in it. And so I think about it maybe a little bit different. And then the juice for me is with the squeeze. I want to get it in the early stages when the trend is going,
Yeah.
so that I can ride it longer. I have less risk because it's new. People haven't figured it out yet, versus at the end of it when I feel like most people have figured it out. But what you're saying holds really true. We had a guy, I won't say from what firm. It's a very, very, very well-known firm, does a lot of debt deals. And all his fundamental work were right on an Australian railroad, like the regulator, all the cash flow, everything is right. But he got wrong. The rates were going to go up, and securities, long duration traded, fell by 25% in Australia, right?
Yeah.
And
So, yeah.
so, if you caught that early switch, that yes, your fundamentals can be right. You're, clicking all of the things that you probably read about and had to study and the like. But if the trend's not going your way, you better go figure out why it's not going your way, right? Because then you didn't really understand the stock. You might have understood the business, but you didn't understand the stock.
Yeah. And then remember, there are heavens, risk is multifaceted. Yeah.
Yeah.
And one of the dominant risks is actually reputation. So you're qualitatively, you can control a lot of risk in the manner that you explained, like trying to alight from, the accepted belief system, trying to be
Right.
earlier.
Yes. Right.
But you take enormous risk on your reputation.
Right.
So,
Yeah, people try to manage for their jobs. And we had our mutual friend David Dredge comes on here and he talks about the problems with the Sharpe ratio, but it's the same concept. It's like managing money for a year and then managing money for another year and not really having a view of what the long term is, because you're either worried about your reputation and your job, or you're just worried about getting your big payout for that year. So you're just doing it on an incremental basis, right? And then that's where all the institutional capital resides these days. I mean, right?
it resides in the world of beta.
Yeah. So all right, let's move to like where we're at today. So Hugh, I watched your podcast you did and read your recent piece. You seem quite excited. Maybe you can tell our listeners kind of what your newest ideas are, and maybe tell that backstory about being in London with the guy from The Big Short.
Greg. Yeah, so I had this meeting with a wonderful chap, David Levinson, Levenson_David. Anyway, I had this meeting with him, and my mind was rushed with the memory of my initial exchange with Greg Lippmann, the Deutsche Bank trader of great lore, the one who brought to the street the subprime, the buying, don't sell the protection, buy the protection, and is famously captured with Steve Carroll playing the hedge fund manager. So essentially playing me, because I'd met Greg either a week or so before that meeting or a week or so afterwards. Yeah, same situation. Greg walks into my office. It was a complex. There was complex. This was a new security. And I had an investment partner, and he got it. And he said, you got to speak to this guy. And I sat down. And the thing about Greg was he just knew. He knew more than anyone in the world at that point. And everyone else was a moron. He just loved being the other guy.
Was.
So I was like, so it was a bad meeting.
Okay.
But I was in the market for a catastrophe trade. My irony and paradox, if we go back to that language, from about mid-2005, I'd actually reacted to a Citigroup research paper proclaiming gold at $3,000. This is so this is 19 years ago. And that was bodacious.
Yeah.
I made my first calendar year. I'd made 50% calendar year return from capturing the incipient gold market. So it was close to me, and so it registered because Wall Street banks back then, they weren't publishing on gold, and it's come for a big name 3,000.
Yeah.
And so again, I go into my how does genius fail and all that, and I was like, ooh. So how do we get gold to 3,000? And so my conclusion was that you actually needed a profoundly deflationary event because what you had to do at the core of the financial system was to breed a revolution, was to make the policymakers, I can't say risk-seeking, but to make them accepting of a more grandiose intervention, because cutting interest rates wasn't working. We'd taken rates after NASDAQ to 1%, um, and it wasn't working. So my notion was, gold gets to 3,000 because we have this near-death situation in the economy. And back then, I'm like, the Fed's going to be at zero. That was my call as I wrote between '05 and '08. And I was heralding these notions of quantitative easing, which is really policy in a world where the Fed has no control. Is language, is communication, right? And there are papers written about this, but that's what I was onto. And so that's how I perceived. And I did think gold would be like a Greek drama with many, many parts, but we could end at that point. And that led me to, I ended up, as you noted in the introduction, I had a 210 steepener. I had $1 million per basis point. It blew 225 basis points in my favor. Boom. I got that. So I was in the market for catastrophe, for a deflationary event. And Greg's telling me, but my dyscalculia, it wasn't coming. But my team were formidable, and they dragged me in and again and again. And I got it. To such an extent that I let Greg use the office. Deutsche Bank are like, honey, you ain't welcome around here.
Yeah.
Like, we don't like what you're doing. We're trying to make money. Like, get out of here. And so I had I had a big position. And then I'll close this story. My custodian bank, Daiwa, the Japanese had bought a European franchise that was based out of Dublin. And back then, and I thought, I always believed in that sharp pencil prodding your spine, that if you ease up, you're going to feel it. You're going to feel it quick. The tension of creativity, the tension to move forward, the tension to succeed. And back then, you could redeem. I made a market in my hedge fund every 2 weeks. And so one of the responsibilities for the custodian bank is to make a valid market in the units of my hedge fund. Yeah. And they came back and they said, we can't do it. We cannot get confidence around the marks from the street. You will have to sell. Imagine. I had
like
it.
You feel like you have this great trade, then the structure that you have in place, which is sometimes you don't think of as your risk, becomes your risk.
Yeah, I mean, there's a lot of people who had, there's a couple of things. I know guys who got pushed out of their positions, whether they were shorts or or there's some people who had the CDS on and they didn't get paid until the government actually got the money, gave them the money in the bailout, right? So even if you had the right trade on, there was a point there where you're like wondering if you're even going to get paid on being so prescient.
Absolutely. I mean, I had the golden ticket to visit Charlie's chocolate machine factory, whatever, and it snatched away. Okay. And that's where I lighted on the 210. And then there was I did again. I was a bit highfalutin, would you believe, where my team were, curve trades can, depending on where you are, but back then there was it was nasty funding. The carry was horrible. And it's like, I mean, I feel it's imminent, but I've been saying that for the last year. So I did want to kind of take on that neg carry. And so I structured it, swap options. And I did the curve 2 years out. I thought without a doubt, within 2 years, this house of card comes down. And two things. I had only one prime broker. So to Ben's point, my clever clients are like, who cares if you're right?
Right.
Like, Morgan Stanley don't pay you. But how I structured it was like, when it did come down, Morgan Stanley, on the Lord, I remember, please, as a capitalist, please, can we close this? I closed down a team, like they all go.
Okay.
I mean, they're all back working, but they were out of work for, I don't know, 6 months. I took $250 million off that team. So yeah, the when there is systemic risk, what is systemic risk if you're a politician? It is when events snowball beyond your power and your capacity to resolve.
Sure.
And you will fight that tooth and nail with every dark art, the abolition of short selling of the banks, etc., and all of the hideous behavior that went on with marks, etc., on portfolios. The truth seers, the discovery agents, we were castigated as the enemy. The enemy was the truth. The truth was unbearable. So that's
So can I
back
ask you
then. So,
something personal? Because I know Ben's got some more questions on this point. But if you say you're not the math guy, right? Let's just say you're saying that. I don't know if I believe that, but maybe you're more visual. You like to see the patterns or think about it more. So who's doing the math when you're doing these? You're using swaptions. You're doing these trades. Who's doing the math then? So just to kind
oh,
of break it down from a team perspective,
oh, yeah,
let
yeah,
people
yeah.
inside you a little bit more.
Oh, absolutely. Um, it's agent and principal. I was a smart principal. I recognize that a smart principal hires agents that are more capable than they are in their silo.
Mhm.
Yeah, and I I ask dumb questions. I'm a robust individual.
Sure.
I get curiosity, and I will not stop. And being silly won't stop me.
Okay.
Um,
Right.
so
So
I
it's by having a team around you that can fill in the things you either don't want to do, feel like that they would be better at or the like. And that's how you make your magic is that you have that a team approach.
synthesis. I had to be separated from that. You can't have me in an office. Music's blaring. I'm moving around. I'm doing downward dog. I don't know. Uh, um, but I have light bulb moments, and then and you both of you know this. What is the first when you see something when it the pathway lights up? What is the first thing you want to do? You want to call a friend,
Hey, you call your
and
buddies.
you want to tell them,
Yeah.
listen, how smart is this? This is amazing. I see the future. And not anyone. You want to tell your closest, the people you respect. And because maybe they're like, no, I don't get it. I don't get it. And you're like, really? And that's, it's like, and then I disappear. I go, well, I say a lot of bad language, and then I leave the room. Uh, but but a lot of times, like, I'm crazy. I'm
No, you're
crazy.
not. It makes a lot of sense. And
But
this is what
but
gets you
look,
passionate and jazzed and gets you to see things, right? Is that you're doing it your way that you need to do. It's like you want to do it that way and you need to do it that way. So that it
Yeah.
makes a lot of
No,
sense.
but I'm saying I'm the provocateur, right? I am not seeking to be rationally or intelligent in a linear manner. I've got that
Right.
covered.
Right.
I buy that off the shelf. Okay.
Yeah.
And there was a great example in 2005. I came in and I wanted to buy a kind of medium-sized British company that produced pumps and valves for the extractive industries.
Okay.
And I wanted to buy it because one of the things I love is a long hiatus, a price barrier, a stock that's had a bear market, that's been eventually discarded from portfolios, largely ignored. And then here we are 15 years later, and it's making a new high. So I'd be describing, I mean, the discarded is too much, but, a Microsoft, I think it was, 4 or 5 years ago when it exceeded the
Right, right. No,
NASDAQ
it was
high.
fallow for a while, right?
Yeah.
Things lose out of favor for a while, and that's what I was getting at of like non-consensus is like what if you can see things switch, then you're in this new trajectory, you can go to that, but
Well,
you do
that you
you
see again. So there was rationality in my purpose because I'm macro. I can do anything, which
sure,
sounds fabulous. But I've got to be focused.
yeah,
Okay, and so I use market intelligence to alight upon the most relevant phenomena in my computer screen. And so when I'm seeing the market. So like everyone's an insider, and then you've got thousands of experts watching from outside. And when a price begins to make and sustain a price above a 10-year high or 15-year high, it's telling you that those who know it best, actually the opacity that the risk premium is dropping, their ability to be able like to Ben's point when he was at Fidelity, actually reading the next 2 years' earnings is a piece of cake, and they're going to be a lot higher. And so I was coming back saying, I want to light on this point. I want to do all of our research here. I'm buying some of this stock already. I really want to buy more, but give me the linear knowledge of it so I can, with risk, I can really accentuate my position. Okay. Now, my team were damn good. And my top guy comes by and is like, you're crazy. It doesn't work. And qualitatively, it being a 6 or 7% nominal GDP grower with some well executed small acquisitions, it made like 10% EBIT, and it was trading on 1.5 times EV to sales. Hope I haven't said that too quickly, but if there's anyone that knows the maths of kind of low growth equities, that's kind of rich. And I'm like, but it's going to triple. And I'm not going to triple. And so I'm like, okay. And I kick the can around and I solve it. I go back and I say, okay, the oil price is $80. Where's the price trade? And they're like, it goes up 4 times. I'm like, there you go. Because at the same time, oil would just reach $40. And I'm very cognizant of that. I'm like, and with the barrier broken, it's going to double. And where did it go? It went to $150 in July of 2008. So you see, it's another way. I'm a creative financial artist. It's a preposterous thing, but I start with a blank canvas and I seek rich, wealthy patrons that want to sponsor a contentious narrative of how the world might be.
I love that.
So I mean, one of the things that I like to think about is that most people or market participants are, I want to be right, I want to be wrong, but they don't think about what's the F of X, right? So when do I get paid if X? So in your scenario, it's perfect. You're like, hey, if oil goes here, I'm going to get 4 times my money. And so you don't always have to be over 50% win rate. If your bets that are less likely get paid a lot, right? So I know you don't like math, but like there's that math work. And so let's bring that back to where we are and the invisible collapse of what do you think's going on right now, and where is that F of X in this market?
Okay. The I had many thoughts when you were talking there. The great thing, I think it's relevant just to light upon it briefly. I think to what you're saying, I never feared being wrong. That's very powerful. Now, that's not to say I was cock steady or whatever. I was, none of that. I wasn't afraid to be wrong because on an ex ante basis, I knew what that cost was. And it was modest because I was supposed to be wrong. Yeah, it was like a crazy notch. I was like, what? $80 oil? Oil's traded at $40 for the last 25 years. Get out of here. Okay, buy me some salt. Okay, so I didn't fear being wrong. Now, back to the present. In this long sabbatical, if you will, that I've taken from the markets, I closed active risk taking in 2017. I've been discovering gaps in my knowledge. And it's been a shock. I thought I was like super smart, super smart. And again, because people will go and they'll check these things. I am not saying I was the greatest hedge fund manager ever. I am saying that I'm very proud that I achieved my initial objective, which was TENURE, that I had 15 years of doing something which filled me with passion. I compounded between 7 and 8% for 15 years, but my returns were orthogonal. And when the system blew up, I made 50% in that month of October.
Yeah.
Okay, so that's all clear. So to the just before the meeting with Levinson, there's a cranky guy. I call him Jesus. Actually, I'm going to change his name to John the Baptist. Jeff Snyder, and Jeff set up this podcast platform, the Eurodollar University, and I started listening. This is like 3 years back. And I'm like, oh my God, I didn't realize this. And it's been enormously helpful and expansive in how I how I engage with markets today. And the manifestation of that is I've been saying that dollar yen, the dollar yen trades 200.
Okay.
And I have been going against, this is classic me, eclectic or asset capitalist, in going against the grain of logic. Now, not the grain of the trend. The trend has, again, reinforced the intellectual prejudice. So that's tick, intellectual prejudice reinforced by trend. I have risk position. The narrative, it has nothing to do with interest rate differentials. The fact that Japan sat on zero, the Fed went to 5.5, and it was just compelling. Okay. There is an enormous carry trade, which is independent of those 2 points in the central bank interest rates, via swaps and stuff. I've got a friend, Bob Toohey, who has a bond risk arbitrage fund, best, I can say, he can't say it, but kind of best performing bond fund of its type since it began over 15 years ago. A very, very humble individual. He does that yen carry trade. It has nothing to do with central bank rates. Okay. The trade that I saw was this euro dollar notion. And again, playing with paradox. So what do we know? We know that the Bank of Japan was the first central bank to adopt the revolution, like a tool to manage monetary policy when there are no interest rates, when you're at zero, when you're on the ZERP. Yeah. So QE. And that was the best part of 24 years ago. And, and it's been so effective that they've had to alter it 27 times. When do you figure out it's not working? Anyway, I have long had this contention. So I believe that, again, talk is cheap. It is so easy to talk about hyperinflation. Oh, the US dollar is going to become the Zimbabwe dollar. I heard now Ferguson, the esteemed Harvard historian, whatever, pontificate that with the advent of American QE in March 2009. And my point has always been that it is profoundly difficult for a politician to generate inflation, because the modern economy is constructed with firewalls which protect it from deviant or fiendish, if you will, inflationistas. And the firewall is largely a function of mass. It is the size of the credit market. It's the size of the treasury market. I think best epitomized, was it 2013, the temper tantrum? Bernanke, he wants to hike, and he's kind of jawboning that he's not sure, but he's kind of putting to the market. And this is a market that's not generating jobs. It's a market where GDP is mediocre, coming out of the deepest. Remember, we had we had a contraction in 2 years. It's only happened on 4 occasions in the last 100 years. It's a very, very rare event. And we're coming out of it, not like COVID, we're coming out of it like trudging through sludge. And he wants to raise rates. But he's been doing this QE thing. The market reacts by pushing rates to 3.5%. Absolutely takes any momentum out of the economy. Market setting interest rates, Bernanke's not. And so it's very, very hard. And so it's very hard to generate inflation, is another thesis. And so my point to you was the Japanese banks have accumulated more of these inert central bank reserves, banking reserves. They've accumulated on their balance sheet for 24 years. And essentially, the central bank is like, hey, listen, we're giving you the potency of the most high-powered money. This is the magic stuff, right? This is like gold in the 1920s. If you possess this, you can expand your assets. And as you expand your assets, you get big bonuses and the economy grows, and it's amazing. This is essentially the truth behind QE. This is how it would work. It would be inflationary, but it ignores behavior.
Right.
And the Japanese and indeed the global private banking sector, been there, done that, went bankrupt in 2008, 2009, had a collar on my bonus. I got regulation up to here. Yeah. And so the premise underwriting dollar yen, dollar 200. I'm making up 200, but something extra. Is what if it was the Japanese who fiddling around, we're going to do something. What if they were the ones that weaponized QE, that weaponized, they gave potency to their banking reserves? And so the idea is, so what is the banking reserve? It's overnight JGB cash notes, whatever, And I go into the Eurodollar system, which is a collateralized ledger system. It's a money. It's a money creating. It's a dollar creation tool, and it's like a pawn shop, And the guy opens in the morning, he's like, "Oh, what do you want? What do you want?" And rather than present a watch, the Tokyo banks are like thinking, "What if I gave you like 10 yards of overnight JGB cash bills? How many? I'm pledging it to you. What line of credit would you give me? How many dollars would you give me?" And the underwriter, the counterpart is like, "JGBs, wow, yeah, I mean they're rock solid, yeah. The Widowmaker, we're over that. They're rock solid. We'll extend you 10 yards back. Really? Wow, okay. And what I'm doing is I'm shorting I'm shorting the dollar. I'm shorting U.S. Treasuries. I want to buy anything that's not a treasury. I want to buy anything, especially anything that's going up and anything that meets the narrative of we're all doomed. We've got a fiscal deficit in the US of 6%, and the economy's booming. We're doomed. They're printing money. They're out of control. Okay, and I'm Japanese, and I definitely don't want to lend back into Tokyo real estate.
Yeah.
Okay, but I look at my big clients, and they're plowing billions into mainland China. Okay, and I'm like, I gotta get over there, and so I go in again. I'm Eurodollar. I've now got dollar credit, and I can then go into China, and I can then offer my credit for risk assets. Okay, and so times are good. Times are good, and that process was done ad nauseum and position, and it's not China. It's everywhere. This is the Tokyo Eurodollar system is probably the largest spigot of dollar creation on the planet. Forget it being called Eurodollar. What happened? So it's kind of in my world, and this discourse is all about the invisible gorilla. And I'm saying to you that in the sabbatical, I'm beginning to see a world maybe of phantoms, the phantoms in the machine that maybe I was otherwise unaware of.
Okay.
And with listening to Jeff, I'm beginning to construct an understanding of the ledger system, right? And the yen in all of our professional lives has been what? Rock steady. It's been the strongest currency. The yen appreciates when there's a gamma event, when people get caught short volatility. You want to own it.
Sure.
And there's huge institutions in London that I respect, and they're so long it for that reason.
I mean, Hugh, if you remember last summer, we were on the phone and you talked, and I was like, "Oh, I want to be long the yen versus the dollar." And you actually did a good job of talking me out of that, which is good because it went from 140 to 160, whatever. But, let's bring it to where we're at now. So the yen's, it has a crash, or, whichever way, the dollar yen crashes. Now it's kind of back at 150. We had the treasury overshoot itself again. Then it sells off 60 basis points, 50 basis points since the Fed. And so now, where are we here in your view of where we're going? What do you see for the next 15 to 24 months here?
The key date here is I'm going to make the date up, but it's not going to be far off. August 21, 2021. 2121. The day that the world was the wider world was made aware of the scale of the property implosion in China. The Evergrande missed the first time they announced the missing of a coupon of a payment.
Yeah.
And of course, they had dollar equivalent $300 billion of outstanding. Dollar yen was 115, never looked back. No, and so for me, what was happening, because again, we want to talk about reflexive or cogs in a gear, which start to reinforce markers and give us a glimmer of capturing alpha. What is happening is, again, like the pawnbroker, the Eurodollar is like, they're only open in the morning. And it's the guy's like, oh, you just got to, he's like, yeah. And so you got to come back. You got to phone. You got to roll your credit position every day, 24 hours. Yeah. And just been watching the Chinese property market and Evergrande, and you guys have got a lot of risk there. Oh, yeah, wise man, China will be the biggest economy in the world. And this progresses and the news gets worse. And of course, we saw the slide in the Chinese stock market back to the wides, to the lows of 2008 as this was occurring. So there's that's the process of discovery, of revelation. And so my Japanese counterpart, he's like, holy, my risk department, I've got to kind of look at this. So what you're doing, so when those Tokyo banks en masse pledge their JGBs, the presumption is it's money.
Right,
and,
right.
And money is treasury, US dollar treasury bills. That's money. But from time to time, the underwriters are willing to extend that definition, and there are valid proxies which have a lot of moneyness, that they resemble U.S. treasuries. The greatest one, the greatest, the most secure asset in the world is arguably a Swiss 10-year, the most advanced, best managed economy in the world. But in the real world, it would be the Bund, the 10-year Bund, German sovereign. The problem there is that I think only 15% of it is actually held in private hands. And it has to be private to pledge it to the system. So what happens is you go a little bit further on the risk spectrum. You're like, well, hey, look, the Italian BTP, so the Italian 10-year sovereign. I mean, with the ECB, we might as well call it a Bund, except it's not, but maybe it is. Okay, so you're various degrees away from moneyness. Moneyness at the center is the treasury, but very much Bunds and JGBs would be very, very close in that orbit of the treasury. And all I'm saying is the descent of the yen, or the ascent of the dollar, is the increasing doubt on the moneyness, on the substitution, on the risk of collateral markdown on the JGB versus the 10-year, and it's got nothing to do with interest rates. So
there's a concept called divisia money, which is what you're talking about. If like actual cash, and then you just move away from there, and this moneyness goes away. And if money is actually just a claim on energy, maybe energy is actually the base money of this. And so, you basically have a situation where it's all kind of on top of each other, right? It's a collateral system. And I think that's where people get in a big mistake is they think of money as a thing, but really it's like an organ. It kind of moves like this, and like depending on credit and confidence, more or less.
It is a belief system. No, I'm not saying that we've created this newfangled world. That belief system is money. In the 1920s, it was gold. A sovereign nation would accumulate gold.
Sure.
I mean, in today's world, China would have accumulated like a mountain of gold, right? Yeah. And then that gold enters the private banking system, and that's a high-powered money intervention, and it's designed to accelerate domestic GDP expansion, so that it brings the trade surplus. China was at like 12% trade surplus to GDP. These are profound outliers, okay? And so in the old system, the collateral is gold, hits the banks, then the banks they ease credit. Credit is plentiful. Maybe asset prices certainly go up. People spend more money. What do you spend money on? You spend money on domestic and overseas. And the system kind of heals itself, and your trade surplus comes down, and you put money, like you then able to transfer collateral to the deficit nations. They can expand their money supply, and you live happily ever after. That didn't happen in the US because what is the term? Immunize. They didn't allow the injection of the gold from about 27 to be high-powered money. It was taken away from the banks. Like, our economy is booming. We're certainly not adding, the potency of this gold on top. And so the US was permanently stuck being a trade surplus and its economy doing very well. And UK was in depression. UK was in depression.
Can I stop you there for a second? Because let's say I'm a listener now and I'm hearing this. And I'm saying, well, what do I do now? Like you're saying that you've come into this view of more risk of, as Ben called it, the organ. And therefore, are you coming up with trades to be
Yeah.
able to take advantage of it? Are you thinking of the follow-on risks from this, the time frame of what's going to happen? Like where do you spend your time and why?
I could not sleep last night. No, I sleep the sleep of a charm person, whatever. Sleep
Right.
is never an issue. I am so lit up in answer to your question because everything I'm seeing takes me back to that fateful meeting with Greg Lippmann in the springtime London of 2007.
Is it because you have a sense that something's going to happen, or you know what it is? Like what is it that's keeping you up?
So I had that and I ended up tweeting at 4 a.m. So I was stuck, and Ben can chronicle this. I was stuck in a kind of moribund channel of going nowhere in my reputational. So I risked my reputation on on big calls. Yeah?
Sure.
And I, from about February, March of 2023, I was advocating to have a position in the dollar ETF in the ultra long treasury
Uh-huh.
position. Um, and and I openly say I need 2 years to hit my drop zone.
Yeah.
Right. So, but yes,
Yeah, you got to run away. You got to run away.
I've got 6 months left. Yeah, I've
Yep.
got 6 months left, and it's been hell. It's been like the Greek tale of pushing the boulder up the
So are
road.
you just reevaluating that? You're doubling down, or what is it like? So you're thinking of your reputation, but like you have to put that aside, I think, in order to do what you do best, right? Because that's just one
Yeah.
element.
Oh no, so the most important has been the lack of price validation.
Right.
Yeah, the lack of trend.
Right.
Now, and even to adopt this position, I cheat, but I had to be cute with my language because I was advocating the purchase of something which had fallen a great deal. And at the beginning, I was saying to you,
Yeah,
my
giving that
read-ups were
consensus, right? Yeah.
5 days going up, so things going down.
You want that little turn so then you can carry it. But you're
Yeah.
saying you didn't believe being non consensus, but in this one you were trying to
Yeah.
be. Or
So the compromise was I was advocating a 2-year leap.
yeah,
Yeah,
okay.
at the money, strikes in January. It would have been January 20. Where were we? It would have been January 25. And yeah, over time you calendar hedge and you push it a little bit out. And again, the one of the things was how hard it is to initiate, like hyperinflation or high levels of inflation, the fire break, and the curiosity. A lot of my work has been conducted on stocks or risk assets. They fail relative to their peer group before they fail in an absolute sense. That's a kind of general wisdom, which is kind of 7.5, 8.5 times out of 10 correct. And so relative asset performance is a fascination of mine. And so if we put it in the vernacular of the ultra long bond, the price peaked at 180, the 10-year 46 basis points back in 2020. And it got as low as about $84. And I've been sitting at 100. Okay.
Wow.
And one of the great analytical errors was I didn't see the robustness of the economy. I was very, very analytically blind, partly because I'm not American. The American mortgage system is very, very peculiar. Yeah,
it's the only one in the world. Fannie Mae, the 30-year fix, right? I mean, they let you live the American dream by taking the other side. Actually, one of our colleagues who runs data science at Stanford was on worked at Fannie Mae running the duration for them back in the day.
She was
well, and actually to that the great, I think it's very important to point out But the carnage, the destruction of 2008, 2009 wasn't the blow up in the Lipman products or whatever, the insurance going wrong. It was when there was margin call
Yes.
and assets had to be disposed of, and asset price started to fall. Falling asset prices, again, the cogs in a gear, it unwinds very, very, very rapidly. So
Well, there was a ton of leverage. The funding, so much of the funding was in the wholesale market, right? Eurodollar was insane. You know how insane Eurodollar was back then? I remember this as a young grad student. They stopped reporting M3 because the Eurodollar market was like doing 20% a year growth. And it was so bonkers. That was the only place you could see it. So they're like, Fed's like, nah, let's focus on the M2. You're looking at the M3.
But I want to lasso you guys till today, though. So, Hugh, I'm bringing you back to the question is, what kept you up last night? And what are you doing about it? I'm a pit bull on this, Hugh. What is keeping you up on, and what are you doing about it?
I need a good woman give me a hard time. Believe me, that's what I'm looking for. I had a profound problem with my tracking error.
Okay.
Which became really, really acute.
Like reputationally, or what are you talking about here?
Analytically, let me explain.
Okay.
Analytically, so this summer, we saw an enormous cascade lower in the 5-year Treasury yield, over 100, maybe 165 basis points. And I would have the presumption, I think many others would be that vector, that rate of change, would be negatively correlated with GDP. And yet you could almost say the nominal GDP expanded 5%, not way above, but somewhere like 5 to 6.5%. So what's going on? And of course, my TLT's like rip my
it's like wake me up. Yeah, wake me up.
And so I was caught in the horns of a dilemma, if you will. And so David Levinson called me, and the best analogy I can give to you is that famous psychology test about it's not assertive, about blindness. Like you're concentrating so much, that you miss things. And it's kids playing basketball, and you're given an exercise to count the white bibs.
You see you miss the gorilla because you're clowning the white shirts or whatever.
Gorilla with the balloon.
Yeah. So I was missing, to answer to keep on message, I was missing the damn gorilla. Because I
tell people now, what's the gorilla? They want to know, what is this gorilla that you're there? Do you think you know the gorilla?
The gorilla that I'd been inattentive of was the $13 trillion U.S. mortgage market. Okay. And to put that in context, U.S. stocks are about somewhere between $40 and $50 trillion. The Mag 7 is about $15 trillion. Right. The gold market, this would be the last one I cite, is about $18 trillion, which is to say, it's a big deal.
Yes.
And how many of us actually are cognizant of what's going on there?
Well, you're talking to a strange audience here. So yeah, that's a rhetorical question for everybody else. But so what in the mortgage market are you saying is the gorilla that you now are noticing?
And so I was not familiar with the gears and cogs of the banking system, which create a profound accentuation of market trend. Okay. So we have this, and it's unprecedented, the degree of refinancing. We got to 30-year mortgage rates of 2.6%.
Right. People went nuts. And everybody seemed to know what to do, right?
Yeah. Now, the implied asset value of those mortgage assets is on the roof.
Sure.
It's huge, right? So I've got this huge asset value, and I've got a duration of 4.5 years. Right. Duration has come in, so the expectation is
pay it off.
Rates are going to zero, and this is all going to get refined off.
Right.
Okay. Except that doesn't happen. Yeah. Except the Fed gets the inflation thing. I mean, when is the Fed ever right? But the Fed starts hiking on my birthday, March 16, 2022. And, it's 25, 50, 75. When they started, it was like, we're going to do 25, maybe another 25. In that year, they do 425 basis
Right.
points. Okay, so who cares?
Right,
I care.
right. They're not going to
Right.
refinance. They're hanging on
Right.
to the mortgage.
Well, the financial ledgers. I started as an accountant.
Yes.
A ledger. I have assets. I have liabilities. Guess what? The equal. I'm in balance. The balance sheet balances. Wow. Okay. Uh, the margins that banks make are like minuscule. And so there is industrial leverage. Okay. When there is industrial leverage, there are, thankfully, not many times, but there are times when something goes askew, if you will, and you are forced into involuntary behavior. You do
Right.
not.
Or yeah, they get surprised. They didn't plan, and then they have to do things that they didn't think they have to do, or figure things out that they didn't have to figure out
I
before.
mean,
So
that's
I,
how leverage works.
yeah. So yeah, it's leverage. It's leverage. Leverage in a short
So the
ball environment.
gorilla. So now you
So
got this gorilla. It's
so
not
what you have to
4.5
remember,
years. Yeah.
I'm coming. I'm coming.
Dragging you.
The
I'm dragging you with me here, Hugh.
Okay. The I'm in balance, which is to say, so I'm Citigroup, and I don't know. I'm making $1 billion of mortgage loans. I've got to have $1 billion of liabilities in my ledger,
Mhm.
and then there's so many great components. Vega, principally rates. The rate, I have. If I've got any rate risk, remember we lost Orange County in
Yeah.
1994. Why? They got a miscalculation on their rate book.
Sure.
With leverage, you've got no equity, right? So I'm sitting there. My duration on my assets is 4.5 years, right?
You think?
Um,
Right.
so I am going to be, let's say I'm 50, 5-year, 10-year.
Mm-hmm.
I'm probably more like maybe I'm 65, 5-year, and 35, 10-year.
Mm-hmm.
And my duration blend on my liability book is the same, right? And what's my liability book? I've issued commercial paper. But
Mm-hmm.
when I've issued it, I can't go back and call it. I can't change
Right. You
it.
mentioned, yeah.
It's it's permanent until expiration. Okay. So that's cool. But Jay's told me for whatever reason to reflect gracefully Ben, that I'm going to get like 25, 50 basis points in the year, but actually it comes with 425. Okay. What happens? My duration book over the course of 18 months, it doubles to
Right.
just over 9 years. Holy Mary. Okay, because we're talking, remember, Citigroup has $2.7 trillion of notional exposure on its balance sheet. It has a market cap today of like $180 billion. So I think what is presently about 15% of its total notional liabilities. There's a lot of damn stuff that can blow up and that equity is gone. We saw
Right.
that happen with Silicon Valley.
Right. In
So,
First Republic. But is it a fault of a lack of creativity or spreadsheet work, or what is it?
no,
Where
no,
no, it's just they didn't understand maybe different choices that would be made by
no.
people, or what is it?
It's
The rate of change is where they got caught off guard. I think it just went too fast for them.
it's an out a bank that banking model is outmoded. It was invented 150 years ago. The concentration of risk, the magnifying of risk with leverage to eschew a profit, and in a world, a short volatility world has two tails,
Mhm.
and one of those tails you can't afford. You actually can't. You don't have the P&L to hit. It's not that you
Right.
don't have the P&L. You don't have the counterparty liquidity to take the
Yeah.
risk away
Yeah.
from you.
Yeah.
Okay. Now that's what was happening. That's what was happening as rates were going up and they were lifting duration. So I'm going to hold on to my mortgage now. I'm not
Yeah.
refining it. Okay, that kind of sounds good, but one thing's already happened. The value of my asset book hasn't blown up. I mean, I'm losing money on my assets, right? My predominant, I'm like, that's hold to maturity. Now, and again, here's another blindness. For 3 years, and with Silicon Valley, I thought that was because they owned like 10 to 30-year US sovereigns.
Mm.
They don't. That loss is from the $13 trillion mortgage book and its magnification via leverage. That's the loss. Now, that loss today is system-wide 132 billion. It's about 6% of book value of the industry. It's not a big deal. And actually, I thought it was a big deal. It's not a big deal. And let me tell you one other maybe contentious thing. But I saw the Johnny. I think that's relevant to recognize. But so but because I was looking at Bank of America and it's the implied loss in the HTM portfolio, it's 70-80% of its book value. But the market is right; it doesn't care. Why? Because it's pro-cyclical, and with rate changes, it goes away. Okay. So the problem is, I sat there and I had 65% 5-year, 35% 10-year. My blend on my liabilities was 4.5 years. My assets, they've just blown up in price, but their duration has doubled.
Yeah.
Okay, so my duration is 9, and my funding is
Mismatch,
4.5.
yeah.
If I keep it like that, I'm gone. Like the loss will evaporate my NAV. So every day I'm chasing it. I'm chasing my tail. Now, Nadine, what do I have to do? Like, let's see if you get it. You're the super smart person.
I'm not. I like to be the village idiot where I break things down for myself.
Well, but I think this is helpful for people who are listening in. The duration of my asset has doubled. I'm funded 65% 5-year, 35% 10-year. I can't change my funding, but I can come in and I can super hedge on top of it. And I'm super hedging to raise the to raise the duration of my liabilities. What am I doing?
You're selling 10 years and buying 5 years.
Exactly. And what am I doing? I'm short selling 10 years because I'm trying to now I want 50-50 hedge ratio. But effectively I'm short covering less of my 5-year and I'm short covering a hell of a lot of my 10-year. Yeah. And that cycle keeps ratcheting. And what am I? And this is 2022. And forgive me if this is a rumble, but it's so essential because it's the outdated model which requires a liquidity from a system which is unwilling to provide the liquidity, which then creates the systemic risk to the system. Because in 2022, we've done the maths, and with the rise in duration, just the banks, the money center banks, well, not just the banks own 20% of the outstanding stock. So everyone, the asset holders of the mortgage debt, they have a demand for about $2.3 trillion of 10-year equivalent. $2.3 trillion. Like when that mortgage book in
But to sell,
they need no. Let me say another way, Ben. They need to find a community of speculators in the year 2022 and early 2023 that want to buy $2.3 trillion of the most reviled asset class, the 10-year treasury. That is the invisible gorilla that I missed. Yeah, because I'm buying everything that's going up, and everything that's going up is this kind of, the Fed are out of control, the economy is never slowing down, the government's fiscal pump priming. I'm buying duration in the equity market. I'm buying Mag 7. I'm buying copper. I'm buying Bitcoin. I'm buying anything. I'm certainly not buying treasuries. No. Something happened.
Let me stop you for a second, because I've written about this and talked about this. Is there's a great symmetry since 2020 of the winners, everything you just said, and then the losers are treasuries and Chinese stocks and the yen. They're on the other side of the symmetry of buy all this stuff, sell all this stuff. It all just revolves around the RMB or the CNH USD, if you will. And so if we're in the fall of 22, you're saying that these guys have to sell bonds into a market that's at 5% and change. No one wants to take the other side. The narrative's strong about, Santelli's on TV talking about 13% long rates and stuff. And so in essence, the banks are pushing the yield higher into a market that doesn't want to take the other side, right? Is that more or less what you're saying?
Okay. So the 5% yield is a year later, October 23. You said 22. So
Sorry.
I think it's very important to set the scene. October 22, again, the invisible, the
I know.
invisible
I'm still
gorilla.
thinking about the gorilla and his friends
They-
here. So I'm waiting. I'm waiting to get
here's
back to the zoo. Yeah.
here's a major flash signal in the market, and I'm blind, I don't see it. Okay. Citigroup is trading $40, pushing below $40, pushing closer to a market cap of 6% of all its notional liabilities. Right now, where is it? Is it 6, 5, 4, 3, 2? Where when you're rolling your CP, the market's like, nah, Credit Suisse.
Yeah.
Like David has a great line. Is Citi, and not to pick on Citigroup in particular, but why not? Their hedging book looks it doesn't look pretty. Is Citigroup the S? Is Citigroup Credit Suisse? It's just lacking the S for security. So, um, so, and I'm missing this because we've lost Silicon Valley, we've lost a plethora of regionals, we've lost Credit Suisse. But I'm counting the bibs in the basketball game, and stocks are over here and AI. Okay, and Citigroup is below $40, and it's telling you we have, and it stays there to Ben's point to October 23, and October 23 we see something very, very rare this century, very, very rare, and all of that fear, call, reflexivity, banks chasing their tail, duration keeping extending. Man, I've got to sell more 10-year. I've got to find 10-year in a market that's unwilling. Okay, so all the price pressure is pushing the 10-year yield higher, and we get the Niederhofer rule of 5. Now, if you Victor Niederhofer is someone that anyone watching this or listening should go to the New Yorker and find their article on Victor Niederhofer. It is fantastic, amazing. And I was reading that, and Victor, I mean, he's careless. I mean, he's Mr. Leverage. Anyway, he's been resurrected again. I don't know how many times he has to blow up, but like some money has no memory. So he's back, and he's managing $300 million in a hedge fund, and it's 2007. It's I think July 2007, and the 10-year yield is 5%. It takes 5.1, 5.2 kind of thing. Yeah, and Vic is like, oh, short me, I want to undo on. I'm my yard. I'm selling the spoons. Right. And so I'm reading this is entertaining. I know what happens. And his notion is this doesn't matter, but his notion is 5%. 5% is a huge candy temptation to actually walk away from the risk over here, the short ball risk, and come over here for 5. Okay. So he's like, that's going to weigh on stocks. Boom, I'm hitting them. Thankfully, um, um, he takes the shot off because stocks actually go on a rip. Stocks from July had a 27% rip higher in the S&P. Okay, and Vic's he's well gone. He's taken off. But what's striking is the 10-year yield passed about no more than 5 trading days at that elevated 5. Yeah. And I brought out the chart, and what it reveals, and please check this yourself, I'm not making this up. I want to say that the number of trading days this century that the 5-year has been able to support and to sustain yields greater than 5% is less than a month. And we're 24 years into the century. So that's kind of interesting. And so it's kind of like 5% is like a nautical plimsoll line, like on these big ocean carrying ships, and it's telling you the maximum load bearing weight. And if you start, you're going to tip. And so it's telling 5, it would seem, because I'm listening to markets, 5 is saying, I'm at a point where I just can't take anymore. I'm at this, but I'm weary. Okay. 5 was where we got to with Citigroup in this shrinking kind of counterparty collateral type issue. Why? Because it can't find the liquidity to square its book, and each day it's unsquared is a day where it's closer to zero in terms of its equity book. So the presumption is that the regulator of the banking system, the Federal Reserve, somehow they get wind of it. You know, Jane calls Jamie, Jamie calls Jay, and it's like, Jane's got a big friggin' problem. She's going to zero. And what happens? And, you know, and again, I'm putting this through my memory.
Right.
We had was it October, November Fed meeting, and they changed the dots.
Right.
We were going to be 100, we're going to be 100.
Language, like, yeah.
And it's like
We're going to
the blue
party
dots.
now. Right.
And so they were taking this
November
linearity, and they're like,
2015.
no, we're, you know, and that marked a bottom for Citigroup stock.
Yeah.
The stock market has rallied. We're at the all-time high, and it's up the best part of 40%. Okay. Now,
And banks have really ramped.
and the best performing.
I mean, these things have been an absolute tear since then.
No, so I was going to say the best performing, but so a popular and a wise trade is to be long JP Morgan and short Citi. Okay, that's worked. It's been a great trade. And why does it work? It works because Jamie's balance sheet is better, which is to say that he did Citigroup over distributed on capital because like everyone hates them and they're like, well, you know, have some candy. Can you like me? They still hate them and they've over distributed. And so the thing about JP Morgan's balance sheet, you know, if we're talking about bell curve distributions, Jamie can take 2 standard deviation move in rates. He's at 5, he can go to 7. Jane's out at 5.
Yeah.
Okay. So, but over the last year, whose stock's been better? Well, Jane, because Jane's come from kind of like dead.
Yeah.
To alive again. Right. And now Jamie's stock's kind of looking. So but
where are you now? But what's the gorilla you're looking at now? You figured this out, and then what does it mean for you?
Well, indeed, it's like, well, couldn't you call me? Couldn't we have had this interview like 2023 and we would have bought stocks?
Sure. And in Europe too, but everywhere. Yeah, we would have been loaded on risk. Yeah.
It's been quite a move.
So back to, I was saying to you, we've had the cascade in 5 years. 160 odd basis points down to about, was it 345 or something like that? In a,
check the Bloomberg.
I can't say a raging economy, but in a 5 to 6%
it's
normal
hanging
GDP.
In there. Yeah.
It's the reverse. We just got, did we get $1 trillion stock worth of refi? Now, if you look at the chart, and maybe we're looking at it now. Maybe we're presenting that. I've sent it to you. Refi has suddenly accelerated, but it's accelerated like from the bottom of the chart. Like, so it's notable, but it's like, let's watch this trend, okay? But the 30-year mortgage dropped 2 percentage points, 2 whole percentage points. That's a huge amount. And you know, you've got Rocket and all these mortgage intermediaries, and they make it so easy to refinance. Like, hey, George, you know,
it can happen.
I can make your money here. And George's like, make it, okay. So, because there was mortgage lending, with the Fed raising rates, and you were getting like 8, 8.5, like depending on the risk. And even with modest risk, you were getting an 8 handle. That's all disappearing.
Right.
Okay.
Although it's backed up 50 basis points in the last couple of weeks since the Fed. We've had a pretty good bond sell-off.
We'll come to that because I believe that is a Machiavellian strategy of the Fed. I think that the Fed are very happy. I would say if my gorilla thesis is correct, they have played it.
Everybody,
like Mozart, okay. And let's try and get there. So,
yes.
You know, let's say my duration has dropped from 9 years and I'm now at 7 years. And I was sitting there and I had I don't know, like 80%. I'm short the 10-year, and I'm 20% long the 5-year. Right now, the duration on my funding book is too high, so it's the reverse. I'm now like, oh, hallelujah! Now uh, I want to. What do I do? I want to buy. I've got to get less 10-year shorts. I've got to buy to cover my 10-year,
Yes.
and I've got to get my 5-year up to like 60% of my exposures. Uh, uh, all of those machinations come through, and that's the gear cog and the reflexivity. Because every time the 5-year thing, it's
Right.
like someone,
Get it.
there's a whale in the market, and the yield because they're fine. I need 5-year. I don't need 10. I need 5-year. I need 5-year. And I'm getting this. That's why he ignores the GDP. It's like GDP. I don't care about
Yeah.
GDP. I'm over here in the plumbing.
Um,
Okay. So, uh, so that's less of an existential problem for the banking system. The big one was Jane go like with Niederhofer at 5, we take 550, 575. Jane's gone.
yeah.
Okay.
Mayhem might be gone also.
Yeah,
I
of
think
course.
those are sitting on a pretty
No,
big one.
yeah, it's systemic 2008 2.0. Okay. So
You could call her Jane Goodall
yeah.
with the
Yeah,
gorilla. Did you get that?
I think yeah. So right, okay, concentrate. I'm talking to myself. So the
As I told Ben, I'm going to chain you down, tickle you, and force you to give me an answer here, Hugh.
you can tickle me anytime. So we've got yields. So again, we're going to look at this chart, another chart. So
Okay.
again, we talked about how kind of one-off the refi thing was during the pandemic, right? And so what this chart shows you, it shows you something really scary. Superimpose a bell curve over it, and what's happened is we have transferred the entirety of the mortgage stock now resides in a very, very specific. There are no tails. It's a very, very
Very
specific.
specifically, yeah.
Yeah, it's like 254% roughly, right? Like 70% of the market or something.
Duration.
I'm saying to you that if the 10-year trades below 3%, so the 10-year trade, because I believe, an argument with the move index volatility and what have you, but the spreads mortgage over had been 200 and they're coming in
300
Yeah.
almost.
300. I think they'll probably come into 100.
Okay.
So I'm looking at 30-year mortgage back mortgage loan being the 10-year at 3, the mortgage is at 4, and I'm saying if we go there and we break, what actually happens is you lose the asset, you lose the entirety. Now maybe they can hedge on the way, but you actually lose as a bank. You lose your raison d'etre, right?
Because everyone prepays, right?
Yeah.
Everyone prepays. Now, like it could be Machiavelli, like a bank that has no mortgage debt, no mortgage assets, no mortgage lending, is a bank that only has recourse to what? Like to buying treasuries, like to lending to the government. I mean, maybe I don't think that's the plan, but actually, that would be a good thing because we need to get rid of the banks. We need to put them to zero because they cause too much systemic risk.
We're going there.
Too much systemic risk.
This is the route to get rid of the banks, huh?
Yeah, whatever. So that's something we got to watch out. The other issue is kind of back to that ledger and the observation about dollar yen. So, and this is the dollar yen story is the universe today, which is the Japanese presented cash JGBs as collateral, and they got credit. Okay, we all know. Again, here's another blindness. Penny didn't really drop this. Really dumb. But yeah, I read all the Schwager books. I read all of the Jesse Livermore books, all the trading books. I knew everything about the bucket shops and how Jesse would write the prices, in these illegal gambling dens. I knew about curb lending. What is curb lending? Lending is you're a retail punter and you go to your bank and you present your equity portfolio as collateral, and they gave you like for like. And I'm like, yeah, go have fun, go buy more.
Yeah.
And I kind of stupidly thought I really stupidly kind of forgot to think about it. I was like, oh no, that ended with the Great Depression. Don't think about it. That is every day, right?
It's also called
And
private equity, but anyways, yeah.
millions, trillions upon trillions of this thing, right? So, so we talk about gold again being a carry trade. Like, I'm carrying at zero and I'm putting over here. I want to say to you that with the gorilla as the duration was going up and the banking system is desperate, like trying to sell tenure, find buyers of tenure, failing and tenure going away from them. I I'm an institutional. I run a hedge fund. I'm smart. And Ben, I'm Ben, right? And during this period, right? Ben. I mean, kudos to you, Ben. Like, you should be a billionaire. But
I
you've
agree.
kudos to Ben. Maybe he is. Yeah, maybe he's mysterious. But kudos to Ben because we had the SOFR contracts basically 99 and 7/8. Yeah, and Ben was awake. I was under a palm tree, and Ben's like, well, they can't go below zero. Institutionally in America, they can with the money market funds, right? So I've only got one tail risk. Wow. The poor is I might burn a bit of carry for a while, but it's not that much, right? The Fed's at zero. Okay. Um. So 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 Ben's NAV because he's a frigging genius. And then he's like, God, this is so damn easy. He's got a cigar. He's like, hey, short me some 30-year treasuries. I mean, why not? Who wouldn't short 30-year treasuries, right? So again, come back to it. I had an NAV starting 2020 of $1 billion. I'm a macro fund. I end that year, my NAV is 1.5 billion. And I go to my prime brokers. I'm like, I want to pledge. The last year I was pledging, we're pledging every day, but yeah, I was pledging $1 billion. Now I've got $1.5 billion. What were you giving me for $1.5 billion? I'm gonna give you one. I think honey, you're gonna go for it. So actually, short treasuries, I would say to you, is the funding. It's not the yen, it's the treasury. And it's the treasury caught in this psychotic rise in yields, which is like heralding what everyone told is the the Zimbabwe dollar. Except we've discussed how you get to points where you're just gonna you make the banking system blow up and go to zero, and it stops at Niederhofer flags and it stops. But my problem to you is we did need to offer at 5. We're now 10-year. Let's call it 3.8. My duration's coming in. I in my bank, it's a pain for the banks. I'm kind of being able to handle it. But, and I mentioned curb lending in 1929. Well, guess who does the curb lending to the hedge fund? Guess who owns the prime brokerage? It's Citigroup and Morgan Stanley and Goldman Sachs and Deutsche Bank and BNP, right? And I'm like, holy, they actually, and everything's gone up. And so we have this, think of it, so we're doing a Newton's cradle, the ornament on your desk. And we've taken rates to 10, we've taken the 10-year to 5. And now I'm contentious, but I'm trying to conceive of a reflexive disorder that takes me to 10-year at 0. Okay. So Newton's cradle.
Okay.
And let's think on Newton, force equals mass times acceleration. It's the mass.
Go ahead. I'll let you.
So are you feeding this gorilla? Are you capturing the gorilla? What are you doing? What are you doing to the gorilla? Are you like shorting Goldman? What are you doing?
Shooting the gorilla?
Yeah, you might be shooting the gorilla. Tranquilizer.
I'm going to turn. I mean, first of all, I'm long dollar, short yen. Okay. I'm legacy long my TLT.
Yeah.
Right.
Sorry.
I've got convexity with my leaps. It's still got life. Okay. So I've got two things. I I'm very wary of the banking system, and so what I'm watching. How do I bring that? Let's talk about being wrong, delineation, so that we can arch out the trade. Um, the everything kind of seems fine. Jane stock, rallied from $39 to the best part of 65. August the 5th this year, that sell off, the money center banks led it. They went down heavy.
Mm-hmm.
Okay, so again, we're back into the reflexive machine, and the reflexive machine aligned with the global deflationary catastrophe, which is everywhere. So the 10-year yield in communist China is 2.12. It's the same yield as kind of 50% communist Germany. I like that thing with Henry. But Japan is 80 basis points. If you look at the nations of Europe, it gravitates at 2%. There's a couple. France has got a bid, it's got a risk premium just now. It's 2%. US 3.8. But China at 2.1. Okay, there is a gravitational force which is pulling the rest of the world. But in the US, and I'll say to you, I feel like we've got the certainty of GDP not having a recession unless there's a systemic blow off. But left to its own devices, we're going to be growing 5 to 6.5% nominal until the end of next year, if not longer. Okay. So now it's like I said to you, delineation. So what I need for confirmation, I need a dollar yen the yen rallied, and I needed it to stop rallying at 140. It did. We're kind of like 147, 148. It's still tentative, but fail passed the first test. The gorilla, the thing that flails, is the banking system, and I've got to watch the Citigroups of this world, and they're in a coma. They're like they're saying nothing. Okay. Newton's force equals mass times acceleration is the big one. So I said to you that curb lending, if you will, run riot. I need to outperform. Okay, and the Mag 7 stocks are, and I've if you've sold everything, I've shorted treasuries, I've made them into funding so that I'm long, and why not just buy them? Because 7 stocks in the end of June this year attained a mass capitalization of 50% of GDP. In fact, 60% of GDP, $18 trillion, the same size as the gold market, right? That's a lot of liquidity, right? That's a lot of energy that has to, and you need more and more for this force thing to keep you multiplying and moving forward. So the one of the things that's flashing for me now is the tech, the Nasdaq 100 and the 7, the FANGs, what have you. Their rate of change has collapsed. It's collapsed.
We were just talking about this morning, Microsoft, everybody.
That's not good. And then my other observation comes back from my personal observation that when I was trading my hedge book in 2007, I was surprised when the Fed cut 50 in 17 years ago. And stocks went on and recorded new highs. The Fed came back, I think, with a 25 basis point cut in December.
2 points in a row.
Yeah, but I think they only did one in December, but it was 25. And what was very noticeable was the next Fed cut, stock prices were trading below where they traded on the first surprise 50. And then to Ben's point, the next 25, lower again. So another limso or litmus test for me, sort of saying, where's the gorilla? And then where's the trade? And the trade again is Newton's cradle. I've taken you from 5% treasuries, and I'm trying to take you to 0 10-year treasury, whatever. 0 Fed funds, sir. The momentum. Where am I? Come on, keep together.
I'll tell you where you are. Let me tell you where you are. All right. So right now you're just talking about, well, what is the trade, right? So you're kind of walking through different elements of the trade and the different ones that you have on in terms of the yen, in terms of the 10-year, your TLT. So, and the things that you were looking at. So you're like, okay, I wanted yen to be at this level. Okay, it was near there. All right, what are the ways I can get from 5 to 0? But what is it? Is this a basket of things that you're looking to do? Are you going to be shorting banks, shorting groups that are like Goldman and Morgan Stanley, or what is this?
Okay, so I'm like cut to the chase. I would be so again with my numbers dyslexia. I would be going to Ben, and
So go through that. This is what I
I'd be
want.
saying, I'm like Ben, and we had this conversation. It wasn't at 4 o'clock in the morning, but before I went, the problem is he lit up my mind. I couldn't damn sleep for 4 hours. But the conversation was old me hedge fund. I'm at home, and I'm like, I've seen it. I've seen the future. Fed's going to zero, and I'll let me come back and tell you why. But Fed's going to go to the market's going to push them to zero. It's taking them to zero. And when I look at market expectations, which are Fed guided expectations, it is what has it been? 3.5% focal point for the reds for December, the SOFR contracts for December 25.
Yeah, I think it's like 96.63 or something like that. So the break even's like 337.
Yeah.
Something
So
like
yeah,
that.
so that's like 3.25, between 3.25 and 3.5% Fed funds rate. And I'm like, I think I don't know, but I'm willing to think that the Fed will be below 2% rates.
Yeah.
Okay. So then with Ben would we'd be up all night. There's like it's like a spaceship. There's charts everywhere. I'm like, I have no idea what you're saying on it.
I call him the
Internet.
chart master. I go to bed with charts with Ben, and I wake up with charts with Ben. Yeah.
Yeah. But essentially, because it's like, get out of here, asset capitalists. They're not going to be below, like, Ben said at this point. Ben came back to me and said, hey, look, I looked at 2008. I looked at the interest rate cut. I looked how far the 10-year yield. It's cute. It's not going to happen. You know what? It's not meant to happen. So when Ben priced it up, we didn't get anything spectacular, but we got a good 8-to-1 type thing, and asymmetric. You lose this, but you have this convex return. I can size that. I'm like, you know what? I'm willing to give it a play in my book. I'm going to have 5% swaption premium on this. That's my big trade. Or, in 2008, I had 12% swaption premium on my book, and it went my way. So that is the trade.
Okay.
That is the trade, and along the and for that to happen, dollar yen trades 160 on the way to 200. Citigroup starts sinking into the 40s again. All the banks are pretty horrible.
Yeah.
You've got I think the Mag 7. This is a foolish thing to say. It may have peaked at 60% of GDP.
Okay.
I don't think you need the system. Credit creation needed a whipping boy. It needed a reserve currency to fund you. And you needed funding because you've got individual stocks at $3 trillion. The GDP of America is what, $26, $27 trillion. The combined market cap is 80. I need funding because I need that quantum of money to keep propelling this thing higher.
Right.
I need funding, right?
Yeah.
So now I don't dare short the 10-year. I don't dare. I don't. So if I don't dare short, the amount of daily new liquidity is created from rising prices. Like, it is BS. All these, they're all guys they've never traded, and they've set up an expertise company, and they'll sell you PDFs, and it's their proprietary liquidity ratio, and it's BS. Complete BS, okay? Very, very famous one. Coins a mint in London. Can't bear it. The liquidity
I know we missed out on that whole gig of the last decade.
The liquidity generation, again, is I'm a $1 billion hedge fund, and I'm invested 100% in the Mag 7. They've just gone up 100%. My NAV is, did I say
getting leverage on
billion?
top of whatever? Yeah.
You get on cap gains in that sense.
That's my liquidity. The more prices go up, the more liquidity and the more reinforcing. Maybe, okay, maybe, because the trend has only been apparent since the end of June.
Yeah.
Okay, but maybe what the prices are telling you, and the delta on the rate of change, 0 to negative. I mean, Microsoft looks terrible, Alphabet looks terrible, Nvidia's clinging in there,
Yeah.
Tesla, whatever, So maybe, and that is a collapse. So what I'm saying to you is this. It's not only in Japan, and Japan is short the treasury. Everyone in the world. If you are, let me be succinct. That just came to me. If you are long Nvidia, you've essentially been short the treasury, and that trade's going against you, and you're going to get pulled. You're going to get pulled on your Nvidia. You're getting a margin call, and it's a whisper just now, and no one hears it, and it's going to get louder, and it gets louder if the rate of change, the delta becomes negative. Now,
The
there's a big
screaming gorilla. That's what we're going to title this. This will be the
Right.
screaming gorilla, Hugh.
why be calling it the silent gorilla? The invisible gorilla.
Well, no, it's going to be
So,
screaming
Hugh,
once that happens.
let me try and summarize it, because I think I have you now. So everybody's made a bunch of money. We faced the bear steepener depth like in 22 fall and 23 fall. They scared the hell out of the policymakers. All of a sudden they're pivoting. They're doing the active treasury management. They do this crazy stuff. We get this rally. So then you got the Mag 7, you got Costco, you got all these big companies, assets going up, real estate going up, and then using leverage to buy more, selling vol. We get Nadine and I were involved in a convexity product where, the vol implied vol this summer was, the lowest since '07, right? So that's just another thing to try and keep it going, to your point. So rates down, vol selling. We're running out of things to keep this thing going. The only way to do it is to get the rates back down. Now, here's the final question. What causes that? Because if we don't have the economy roll over and inflation doesn't roll over, how can they get there, I guess? And the refi should be positive for the economy as one thing that should keep the economy going a little longer once we get to that point, I guess.
But I love you because I neglected that part of my presentation. It's one of my favorite parts of the newly formed ideas in my mind. What was the one thing we dreamt of? Goldilocks. What is the one thing that could be the spanner in the works that just blows the damn thing up? Goldilocks. Okay. Because Goldilocks kind of denies the Fed the opportunity to get rates to 0.
Right.
All right. And as a statement, if you were reading this in the transcript, you're like, almost like, well, Goldilocks.
It's kind of it actually is what you see. Like, they're screwed. The bear steepener is the death nail for all these guys. That's the systemic risk, right?
What I'm saying to you is that there is a mountain of deflation offshore. We're in hurricane season. We've got a deflationary force 9 offshore, and it's getting closer. And we're seeing it's getting closer because of how yields, because the needle offer came in and the system pivoted and changed, and now the Fed's cutting. The Fed is what's the disaster in China financially? I mean, where do you begin? Okay, but in terms of,
I was like, I don't think we have another hour, Hugh. Go ahead.
No, in terms of remedy,
For that,
in terms of remedy, the 10-year sunk in conjunction with the 2-year to kind of 0. And for a bank, I'm dead. I make no money. I've had the runoff of all my assets, and I've had margin compression, and I've had a nightmare chasing my tail trying to hedge us all the way down. I'm going to lose the viability of my bank. So in China, what a bank price to NAV is what? 25% is a highly rated bank. Yeah. Do you want to see that in the US? That's what the Fed, let me tell you, if I'm right, the economy ain't flowing down because, people paying 8.5% of the mortgage, they're not paying 6.
Yeah.
They feel better.
Feel rich. Yeah.
Yeah. And I'm saying to you, it might, if the Fed had intervened, the 6% might be 4. And at 4, I've got like $2 or $3 trillion, which has just been repriced. Wait, I know. You know what? I'm feeling flush. I'm thinking I'm going to go to Lululemon. I could never afford those pants. Now I think I can afford them. You know what I mean? And maybe I'm going to move house. I surprised, and I'm bidding house price. Oh my God, like wealth effect. The government, the treasury, there's I think $36 trillion of treasury debt, 10-year adjusted. I think it's between 16 and 18. Why? Because it's all fucking problem. It's all frigging 1 year. Johnny gets a bad case, but uh, they've got 1 year, right? So say the Fed gets rates down to less than 2%, and we make 8 times on our protest. My funding for the treasury, like the forecast is like, oh, it's going to be $40. Like, no, actually, well, yeah, the funding cost, right? Plus the economy is not slowing down, right? I'm actually looking a lot flusher. Then, God forbid it's Trump. Someone called me like anti-Trump. I'm a father. Like he's not even a good businessman. But imagine, and we were sharing conversation earlier. Clearly, Elon is going to be charged with being the Argentinian Milei.
Yeah.
We're going to have acid. We're going to have Ayn Rand, Atlas Shrugged, finally resolved. And Stan Druckenmiller is the person I respect more than anyone in the world of finance. Stan's short pressures. It's like, Stan, you got to Stan. I mean, maybe there's a chance because you've got a highfalutin show. I bet there's some smart people, and maybe some of the works in Stan's works. Like I'm an ex Soros guy. Like, let's talk, Stan. No, Stan is showboating. He announced he was 20% NEV short treasuries. Ben, what does that mean? Or Nadine, what does that mean? Forgive me. I'm like, just he's closer on my screen than you are.
No, he's probably just getting out of it. Once they've announced it, then they're getting out of it.
He's got no position. 20% NEV, like 10-year treasury short. Get out. Shut up. Right. That's nothing. Right. But he has a political axe. He doesn't like that. I love Stan. This is why I can't sleep. It's like, oh my God. Like we're seeing the future here.
So I was on our friend Darius's podcast this summer, and I said something similar in July that the assumption under the market is such that like deficits forever, and then public deficits are private surpluses, which underwrites the stock market and is bad for bonds. And I think I sent you a chart at some point of the ratio of bonds to stocks is at a historic deviation. Now it's come in some, and so everybody hated bonds, everybody hated yen, everybody loved stocks. And so what would usurp that? It would have to be, if rates do go down, it's $100 billion against the deficit for every 100 basis points. And then, God forbid, they just make it more efficient. There's another couple hundred basis points. And then that deficit gets cut. And then that's really bond bullish. And that's bad for the private sector corporate profits. And that will be what would resort it domestically, independent of all the stuff going on, cross-border flows and all that, which is significant. But I'm with you on that. No one's talking about that, and that's something that could be very serious, and that's your bond bull case mega.
So the paradox is that the Fed really, really was a joker with that Fed meeting. Because the Fed, what does the Fed know, right? It is the regulator of the banks. It knows the banks. It knows position. It knows the tenuous nature of leverage and stuff. And it always indicates so that you're adjusting these gigantic hedge books. Forget hedge funds. We're talking about Citigroup, JP Morgan, etc. You kind of know. The Fed tells you, it tells you in the press, that they send the governors out. Didn't do it. It was like good. It was 25, but it was 50. That's a huge difference. I'm the rate guy. The rate, Nadine, I'm the rate guy. Is Citigroup fine? I'm like, what? Okay. The Fed, I think it's a bit like Brooklyn with the Japanese, if you remember, who advocated the QE and others. And it's like, you're at the point where you got to convince the market that you're crazy. I mean, the Fed should be appointing Joe Rogan. Make Joe Rogan the Fed.
What do you have against you? I like Joe Rogan. What's up?
Do you like him as the Fed chairman?
I'm kidding you. I'm kidding you, Hugh.
The Fed the number one danger to that. So this, no, I don't think anyone apart from David Levinson and myself, I don't think anyone's really focusing on this. The primary risk, systemic risk to the U.S. economy is that the 10-year U.S. could join the majority of other global sovereign debt yields at 2%. At 2%, the U.S. banking system would lose all of its mortgage stock. And if you will, this runoff and what it does to these colossal industrial scale leverage books, the knock-on impact, you get a margin call on the funding currency. And so I'm so glad you mentioned, let me breathe. As I breathe, we're going to look at what I think are the most spectacular charts, and they're Ben's charts. And Ben did a standard deviation analysis of the total return bond performance vis-a-vis the S&P and vis-a-vis gold. And what we know clearly is that these great giant banking hogs were weighed so heavy on the price of U.S. Treasuries that they're trading beyond 2 standard deviations, beyond all the data and history. Like in terms of our curve, we're not on tail, we're not 3 standard deviation, but this is very, very rare. And actually, we now have the conception of something which could take something which is very rarely positioned like down here, and it could zoom it to the most preposterously high levels. And the process of that would be this unleashable, untamable global march lower in yields, which wipes out the profitability of the banking system, and it's a margin call on everything. So I said to you, you're long Nvidia, you're short the 10-year. And if the 10-year yields 2 to 3%, you've lost.
I agree with this. I agree. That's exactly what my view is as well.
So Hugh, I know we could spend hours longer with you dissecting the macro markets and the economy and gorillas. So thank you for sharing all of what paradoxical gorillas, really, and Goldilocks, as a blonde one here. I like her too. But thank you for sharing all of your wisdom and experience with us today. And so if people are interested in learning more and going into depth and getting updates on your views, what can they do to keep abreast of your thoughts and what you're doing?
Absolutely. So thank you. It has been wonderful.
Where do they find you? So where is it? Your podcast, Substack. Yep. Okay. Okay. Well, I know. I want them to be able to follow and get into your head. So that's why I'm asking is where do they go to make sure that you have enough to live where you're living and keep on talking on our podcast? Did we lose Hugh?
Dude, we lose you. Did the hurricane come in time?
Uh-oh.
You got hurricane. It's just.
Uh-oh. Did he click it?
Well, I think it's okay, but we don't want him to close, though.
As long as he doesn't close.
Right, yeah, you don't.
I'm going to stop recording here.
All right, Hugh. Well, this has been quite a blessing and a lot of fun to go down to the jungle and hunt some gorillas with you. Why don't you tell our listeners where they can find you if they're interested in, navigating these choppy waters over the next couple of years?
Well, I can be found on the platforms of Substack and Patreon. Yes, I am a filthy capitalist, and I demand to be paid for my intellect. Sorry, but I am also broadcasting for free on Twitter at Hendry_Hugh. And if you want to see blind goats, real goats, and little cute turtles, I'm on Instagram.
That's apropos for that platform. All right. Well, thanks again, buddy. Look forward to talking to you again soon.
Thank you.
Just beware of gorillas.
I'll leave it at that. Thanks, buddy.
Perfect.
All right.
Great. Thank you, guys. Appreciate it. Oh, can you